Stock market crash. Just hearing those words can send shivers down an investor's spine. Images of flashing red screens, portfolios shrinking, and financial futures crumbling. Most people run for the hills. They panic, they sell, and they often lock in their losses. But what if I told you that a market crash isn't just an unavoidable part of investing? It can actually be one of the greatest wealth-building opportunities of your lifetime. What the video covers. That's right. While everyone else is panicking, you could be positioning yourself to get rich. In this video, we're going to dive into why market crashes happen, how to conquer the fear they induce, and most importantly, the actionable strategies you can use to not just survive a crash, but to thrive and build significant wealth from it. We'll cover understanding cycles, managing your psychology, spotting opportunities, the power of dollar-cost averaging, and cultivating a long-term mindset. So, if you're ready to turn fear into financial fortitude, stick around. Point 1. Understanding market cycles. It's normal. First things first, market crashes are normal. They are an inherent, inevitable part of how markets function. Think of the stock market like the economy's heartbeat. It doesn't just beat at a steady rhythm. It has stronger pulses, and sometimes it skips a beat or two. Since its inception, the stock market has experienced countless corrections, 10% drops, bear markets, 20% drops, and full-blown crashes. And you know what else it's done every single time? It has recovered, and then some, reaching new all-time highs. Understanding this historical context is crucial. A crash isn't the end of the world. It's a phase in a larger, upward trend. Knowing this helps you depersonalize the event and view it as a natural cycle rather than a personal attack on your portfolio. Point 2. Conquering the fear, your biggest enemy and asset. Now, let's talk about the elephant in the room. Fear, when you see your investments losing value, your brain's primal fight or flight response kicks in. The urge to sell everything and stop the bleeding is incredibly powerful. This is where most investors go wrong. They sell at the bottom, locking in their losses, and then miss out on the subsequent recovery. Your biggest enemy during a crash isn't the market itself. It's your own emotional reaction to it. But here's the secret. If you can master your emotions, that fear that grips others becomes your greatest asset. Why? Because fear drives prices down, creating the very opportunities we're talking about. How do you conquer this fear? Have a plan before the crash happens. Understand your risk tolerance. Diversify your portfolio and know your investment horizon. If you're investing for 10, 20, 30 years or more, short-term volatility becomes noise. Point 3. Identify opportunities. When to be greedy. This brings us to the exciting part. Identifying opportunities. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." A market crash is precisely when others are fearful. This is your chance to be greedy, but smart greedy. Think of it like this. Imagine your favorite store suddenly announcing a 30%, 40%, or even 50% off sale on high-quality goods. Would you run away? Or would you seize the opportunity to buy more of what you love at a discount? The stock market crash is the ultimate, everything must go sale for great companies. Focus on fundamentally strong companies that have solid balance sheets, consistent earnings, and a proven business model. These are the companies that will not only survive the downturn, but will thrive on the other side. Do your research. Identify these high-quality assets, and prepare to add to your positions when their prices become attractive. Point 4. The power of dollar-cost averaging DCA. For many, the idea of timing the market to buy at the absolute bottom feels impossible, and honestly, it usually is. That's why one of the most powerful strategies during a volatile market is dollar-cost averaging DCA. Dollar-cost averaging simply means investing a fixed amount of money at regular intervals, regardless of market conditions. When the market dips, your fixed investment buys more shares at a lower price. When it rises, it buys fewer. Over time, this strategy smooths out your average purchase price and can significantly boost your returns during a recovery, precisely because you were buying more when prices were cheap. This removes emotion from the equation and ensures you're participating in the sale without trying to perfectly predict the bottom. It's disciplined, automatic, and incredibly effective for long-term wealth builders. Point 5. cultivating a long-term mindset. Ultimately, getting rich during a stock market crash boils down to one critical factor: having a long-term mindset. Short-term traders might try to profit from daily swings, but true wealth is built over years, even decades. A crash that lasts 6 months or even a year might feel devastating in the moment, but in the context of a 20 or 30-year investment horizon, it's a blip. Your goal isn't to avoid the blips. It's to stay invested through them and capitalize on the long-term upward trajectory of the market. Look at the historical charts. Crashes are barely visible as small dips on a long enough timeline. Your biggest advantage is time. The longer you're in the market, the more time your investments have to recover and compound. Conclusion: don't panic. Get rich instead. So, the next time the headlines scream, stock market crash, don't panic. Take a deep breath. Understand that this is a normal part of the cycle. Master your emotions. Look for quality companies on sale. Systematically invest through dollar-cost averaging. And above all, keep your eyes firmly fixed on your long-term financial goals. Market crashes are not just moments of fear. They are a moment of immense opportunity for those who are prepared, disciplined, and have a long-term vision. They are where truly significant wealth is often made. So, instead of panicking, remember these strategies and position yourself to get rich instead. If you found this video helpful, please give a thumbs up, share it with a friend who might be panicking, and subscribe to the channel for more actionable investing insights. Let me know in the comments below, what's your strategy for handling market downturns? Thanks for watching, and I'll see you in the next video.